Do you want to successfully complete the C214 Objective Assessment Exam? Then you are in the right place. Our website provides a list of questions and answers for your success in the C214 OA exam for free. We understand that acing your OA exam can be quite challenging. That's why we provide completely free exam guides and practice questions for you. In this video, we will cover questions from capital budgeting, time value money, risk and return, cash flow analysis, capital structure. So let's dive right in. 1. A technology startup needs substantial funding to develop its new product line, but cannot obtain a traditional bank loan due to the large amount required. Which approach would most likely allow this company to raise the necessary capital directly from investors while providing them partial ownership in the firm? A. Issuing treasury securities. B. Establishing a line of credit. C. Selling corporate bonds. D. Conducting a stock offering. Do you know the answer? Correct answer. D. Conducting a stock offering. Explanation. Option D is correct because selling stock shares allows firms to raise capital by offering ownership stakes to investors, which is ideal for large funding needs that exceed traditional lending limits. Option A is incorrect because treasury securities are issued exclusively by the United States government to fund governmental projects and operations, not by private corporations seeking expansion capital. Option B is incorrect because a line of credit is a borrowing arrangement with a financial institution, which the scenario specifically indicates is not feasible for this large amount. Option C is incorrect because while corporate bonds raise capital, they represent debt obligations requiring interest payments rather than providing investors with ownership stakes in the company. So this question is really asking, how does a startup raise serious money when banks won't lend them what they need? The answer is stock. When a company sells stock, they're selling pieces of ownership in exchange for capital. Investors become part owners of the business. This is completely different from debt. Bondholders are lenders who want their money back with interest. Treasury securities? Those are government issued, not corporate. A line of credit is just another form of bank borrowing, which the question tells us isn't working here. The key phrase is partial ownership. That's your signal pointing straight to stock. Here's a WGUC 214 OA exam tip for you. When you see ownership stake or partial ownership, think equity. Stocks equal ownership. Bonds equal debt. Quick recall hook. Stock equals sign stake equals sign share of the company. 2. When a pharmaceutical company decides to borrow money from investors through a structured arrangement requiring periodic interest payments and eventual principal repayment over a 20-year period. Which type of financial instrument best describes this arrangement and the associated obligations to those investors? A. Corporate bonds. B. Common stock shares. C. Preferred equity certificates. D. Treasury notes. Do you know the answer? Correct answer. A. Corporate bonds. Explanation. Option A is correct because corporate bonds are debt instruments issued by companies that require periodic coupon payments to bondholders and repayment of principal at maturity over specified terms. Option B is incorrect because common stock shares represent ownership in a company rather than a debt obligation, and they do not guarantee periodic payments or principal repayment obligations. Option C is incorrect because preferred equity certificates are hybrid securities representing ownership with fixed dividends, not debt instruments with maturity dates and required principal repayment obligations. Option D is incorrect because treasury notes are debt securities issued by the federal government to fund governmental operations, not instruments available for corporate borrowing purposes. Let's break down what's actually happening here. A pharmaceutical company wants to borrow money, pay interest periodically, and pay back the principal after 20 years. That's the textbook definition of a bond. Corporate bonds are debt instruments, IOUs from companies to investors. The company promises coupon payments along the way and returns your principal at maturity. Common stock, that's ownership, not debt. No guaranteed payments, no maturity date. Preferred equity is a hybrid. It has ownership characteristics with fixed dividends, but still no principal repayment obligation. Treasury notes are government debt, not corporate. Here's a WGU C214 OA exam tip for you. When the question mentions periodic interest payments plus principal repayment at a specific maturity, you're looking at a bond. Quick recall hook. Bond =, borrow =, must pay back. 3. A manufacturing firm is preparing to sell ownership shares to the public for the first time and has engaged investment banks to determine appropriate pricing and purchase all shares for resale. Which term most accurately describes the role these investment banks are playing in bringing these securities to the market? A. Market specialists. B. Retail brokers. C. Underwriters. D. Hedge fund managers. What do you think is the answer? Correct answer, C. Underwriters. Explanation: option C is correct because underwriters are financial institutions responsible for determining security values, purchasing securities from issuers, and subsequently reselling them to investors in primary markets. Option A is incorrect because market specialists are individuals employed by exchanges to maintain orderly trading by providing liquidity and managing bid-ask spreads in secondary markets only. Option B is incorrect because retail brokers facilitate trades for individual investors in secondary markets rather than purchasing entire security issues directly from issuing corporations for resale. Option D is incorrect because hedge fund managers oversee pooled investment funds seeking returns through various strategies, not facilitating the initial issuance of corporate securities. Here's a question about who does what when a company goes public. The scenario describes investment banks determining pricing and buying all the shares to resell them. That's underwriting. Underwriters take on the risk of the initial offering. They purchase securities from the issuing company and then sell them to investors. They're the middlemen in primary markets. Market specialists work on exchange floors maintaining orderly trading. That's secondary market stuff. Retail brokers help individual investors buy and sell in secondary markets. Hedge fund managers run investment funds seeking returns. They're buyers, not facilitators of new issues. Here's a WGU C214 OA exam tip for you. If a question mentions investment banks purchasing entire security issues for resale or setting the initial offering price, the answer is underwriters. Quick recall hook. Underwriters =, under the new issue =, buying it first to resell. 4. An investor notices that stock prices for a particular company change rapidly throughout the trading day based on new information about quarterly earnings. This price discovery occurs primarily in which type of market where previously issued securities are bought and sold among investors? A. Primary issuance market. B. Secondary trading market. C. Syndicate placement market. D. Underwriter distribution market. Can you guess the answer? Correct answer, B. Secondary trading market. Explanation. Option B is correct, because secondary markets are where previously issued securities trade among investors, allowing prices to adjust continuously based on supply and demand reflecting new information. Option A is incorrect because primary issuance markets are where securities are first sold by issuing companies to investors, not where ongoing trading and price discovery among investors occurs. Option C is incorrect because syndicate placement describes the process of investment banks working together to place new securities with initial investors, not ongoing trading activity. Option D is incorrect because underwriter distribution refers to the initial sale of securities from underwriters to investors, occurring before securities enter the secondary market for trading. This question is testing whether you understand the difference between primary and secondary markets. Stock prices changing throughout the day based on new earnings information? That's happening in the secondary market. The secondary market is where investors trade securities among themselves after the initial issuance. It's where price discovery happens continuously. Supply and demand shift as new information arrives. The primary market is where securities are first sold by the issuing company. Syndicate placement and underwriter distribution both describe parts of that initial sale process. Once underwriters sell to initial investors, those securities enter the secondary market for ongoing trading. Here's a WGU C214 OA exam tip for you. If the question describes ongoing trading, price changes based on news, or investors buying from other investors, that's secondary market activity. Quick recall, hook. Secondary equal sign, second-hand equal sign already issued, now trading. 5. A financial analyst is explaining different market structures to new employees and describes one where multiple competing dealers hold inventory of stocks and trade through electronic networks rather than at a physical location. Which secondary market structure does this description most accurately characterize? A. Auction market structure. B. Specialist market structure. C. Floor trading structure. D. Dealer market structure. Can you guess the answer? Correct answer, D. Dealer market structure. Explanation. Option D is correct because dealer markets like Nasdaq operate through networks of dealers who hold inventory and compete with each other to buy and sell securities without requiring physical locations. Option A is incorrect because auction markets have physical locations where a single specialist takes bids from participants and sells to the highest bidder, unlike the described electronic network. Option B is incorrect because specialist market structure describes auction markets where one designated specialist provides liquidity for each stock, not multiple competing dealers trading electronically. Option C is incorrect because floor trading structure refers to physical trading floors at exchanges where traders conduct transactions in person, contrary to the electronic network described in the scenario. This one is asking about market structure, multiple competing dealers, holding inventory, trading through electronic networks, no physical location. That describes a dealer market. Nasdaq is the classic example. In dealer markets, multiple dealers compete to buy and sell securities, posting their own bid and ask prices. Contrast this with auction markets like the NYSE, where a single specialist handles each stock on a physical trading floor. The specialist system has one designated market maker per security maintaining order. Floor trading means actual people on an actual floor. The scenario specifically mentions electronic networks and no physical location. Auction markets and floor trading are the opposite. Here's a WGUC 214 OA exam tip for you. Multiple dealers plus electronic networks equals dealer market. Single specialist plus physical floor equals auction market. Quick recall hook. Dealer equal sign, dispersed equal sign, distributed electronically. 6. A publicly traded company must decide between two strategic initiatives, and the board of directors is evaluating which option best aligns with traditional corporate finance theory regarding the primary objective that management should pursue. Which objective has traditionally been considered the fundamental goal of the firm? A. Minimizing operational expenses. B. Maximizing market share growth. C. Maximizing shareholder value. D. Maintaining stable employment levels. What do you think is the answer? Correct answer, C. Maximizing shareholder value. Explanation. Option C is correct because traditional corporate finance theory holds that management should make decisions that increase the firm's stock price, thereby maximizing the wealth of shareholders. Option A is incorrect because while minimizing expenses can contribute to profitability, This narrow focus may sacrifice growth opportunities and does not represent the comprehensive firm objective. Option B is incorrect because maximizing market share might not translate to shareholder value if growth comes at the expense of profitability or requires excessive capital investment. Option D is incorrect because maintaining stable employment, while socially valuable, is not the traditional primary objective and may conflict with decisions that maximize shareholder returns. This is testing a fundamental concept in corporate finance. What is the primary goal of a firm? According to traditional finance theory, it's maximizing shareholder value, meaning increasing the stock price. Managers should make decisions that grow wealth for owners. Minimizing expenses, that's too narrow. You could cut expenses and kill growth opportunities. Maximizing market share doesn't automatically translate to value. You might gain share while losing money on every sale. Stable employment is socially valuable, but it's not the traditional corporate finance objective. When boards evaluate strategic decisions, shareholder value is the standard measure. Here's a WGU C214 OA exam tip for you. When a question asks about the fundamental or primary goal of the firm in traditional finance theory, the answer is maximizing shareholder value or wealth. Quick recall, hook, shareholder value =, stock price up =, traditional goal. 7. A company's chief executive officer decides to renovate the executive office suite with expensive furnishings using company funds, despite shareholders preferring that capital be invested in profitable projects. This situation illustrates which common problem in corporate governance that arises when managers pursue their own interests. A. Market inefficiency problems. B. Liquidity constraint problems. C. Regulatory compliance problems. D. Agency cost problems. What do you think is the answer? Correct answer, D. Agency cost problems. Explanation. Option D is correct because agency costs occur when management makes decisions serving their own interests rather than maximizing shareholder value, such as unnecessary personal expenditures using company resources. Option A is incorrect because market inefficiency refers to situations where security prices do not fully reflect available information, unrelated to managerial decision-making that conflicts with shareholder interests. Option B is incorrect because liquidity constraint problems involve insufficient cash or inability to quickly convert assets, not management prioritizing personal benefits over shareholder value creation. Option C is incorrect because regulatory compliance problems involve failing to meet legal requirements, whereas this scenario describes management self-dealing that may be legal but against shareholder interests. Here's a corporate governance classic. A CEO using company money to renovate their personal office with expensive stuff instead of investing in profitable projects. That's an agency cost problem. Agency costs arise when managers, the agents hired to run the company, make decisions that benefit themselves rather than the shareholders who own it. The CEO's interests diverge from owner interests. Market inefficiency is about whether prices reflect information, completely different concept. Liquidity constraints are about not having enough cash, not about how managers spend it. Regulatory compliance involves legal requirements, and this spending might be perfectly legal, just wasteful from shareholders' perspective. Here's a WGU C214 OA exam tip for you. When you see managers pursuing personal benefits or interests that conflict with shareholder value, think agency costs, quick recall. Hook agency =, agent acting for themselves, not owners. 8. A major business organization recently advocated that corporations should consider the interests of customers, employees, suppliers, and communities alongside shareholders when making strategic decisions. This perspective represents which approach to defining the purpose of a corporation in modern business thought? A. Stakeholder capitalism approach. B. Shareholder capitalism approach. C. Market efficiency approach. D. Agency alignment approach. What do you think is the answer? Correct answer, A, stakeholder capitalism approach. Explanation. Option A is correct because stakeholder capitalism holds that firms should benefit all stakeholders, including customers, employees, suppliers, and communities, not exclusively shareholders when making decisions. Option B is incorrect because shareholder capitalism focuses primarily on maximizing returns to shareholders, rather than balancing the interests of multiple groups affected by corporate decisions. Option C is incorrect because market efficiency refers to how quickly and accurately prices reflect available information, not a philosophical approach to corporate purpose and responsibility. Option D is incorrect because agency alignment describes efforts to ensure management interests match shareholder interests, not the broader consideration of multiple stakeholder groups beyond owners. This question is about corporate purpose philosophies. The scenario describes considering customers, employees, suppliers, and communities alongside shareholders. That's stakeholder capitalism. Stakeholder capitalism says companies should benefit all parties affected by their operations, not just shareholders. It's a broader view of corporate responsibility. Shareholder capitalism is the traditional view, focused primarily on owner returns. Market efficiency relates to how prices incorporate information, not corporate purpose. Agency alignment is about getting managers to act in shareholder interests, still focused on shareholders as the primary beneficiary. Here's a WGU C214 OA exam tip for you. If a question mentions balancing multiple groups like employees, customers, suppliers, and communities, the answer is stakeholder capitalism. Quick recall hook. Stakeholder equal sign. All stakes equal sign. Everyone with a stake in the company. 9. A company's board of directors is designing a compensation package for the new chief financial officer that will discourage decisions made purely for personal benefit. Which compensation strategy would most effectively align management incentives with shareholder interests according to corporate governance principles? A. Guaranteed high base salary. B. Company stock ownership grants. C. Extended vacation allowances. D. Premium office accommodations. What do you think is the answer? Correct answer, B. Company stock ownership grants. Explanation. Option B is correct because granting stock ownership to managers aligns their financial interests directly with shareholders, motivating decisions that increase stock price and benefit all owners. Option A is incorrect because guaranteed high base salary provides compensation regardless of performance and does not create incentives for managers to maximize shareholder value through decisions. Option C is incorrect because extended vacation allowances represent additional benefits for executives that do not connect managerial compensation to company performance or shareholder returns. Option D is incorrect because premium office accommodations are perquisites that benefit managers personally and actually represent the type of agency cost that shareholders wish to minimize. How do you get managers to care about what shareholders care about? Give them stock. This question asks which compensation strategy aligns management incentives with shareholder interests. Stock ownership grants make managers part owners. When the stock price goes up, managers benefit directly. Their financial interest becomes identical to shareholder interest. A guaranteed high base salary pays regardless of performance, no alignment there. Extended vacation is a nice perk but doesn't connect pay to company value. Premium office accommodations are actually the agency cost we discussed earlier, personal benefits that don't help shareholders at all. Here's a WGU C214 OA exam tip for you. When asked about aligning management and shareholder interests, stock-based compensation is the standard answer. Quick recall hook. Stock grants equal sign skin in the game equal sign. Same interests. 10. A family-owned manufacturing business with no publicly traded shares faces a strategic decision about expanding operations. The owners decide to prioritize keeping control within the family over pursuing maximum financial returns. How does this private company's definition of value likely differ from that of publicly traded corporations? A. Private firms ignore profitability entirely. B. Private firms only focus on revenue. C. Private firms may value non-financial factors. D. Private firms reject all growth opportunities. Do you know the answer? Correct answer. C. Private firms may value non-financial factors. Explanation. Option C is correct because privately held family businesses often prioritize objectives beyond financial returns, such as maintaining family control and legacy, which influences their strategic decisions. Option A is incorrect because private firms still consider profitability as important for business sustainability. However, they may balance financial goals against other family or personal priorities. Option B is incorrect because focusing only on revenue without considering costs and profitability would not sustain any business, regardless of its ownership structure or strategic priorities. Option D is incorrect because private firms pursue growth opportunities when aligned with their values. They simply may weigh family control and other factors alongside financial returns. Private companies operate differently from public ones. This family-owned business prioritizes keeping control within the family over maximum financial returns. They're valuing non-financial factors. Private firms can define value however they want: family legacy, control, employee welfare, community impact. They don't have public shareholders demanding maximum returns. This doesn't mean they ignore profitability. Any business needs profits to survive. And they don't reject all growth, just growth that conflicts with their non-financial priorities. The point is they have flexibility to weigh factors beyond pure financial returns. Here's a WGUC 214 OA exam tip for you. When comparing private and public firm objectives, remember that private firms may prioritize non-financial factors, like family control and legacy, that public firms cannot. Quick recall hook. Private =, personal priorities =, non-financial factors allowed. 11. A financial analyst is reviewing a company's financial statements and notices that net income differs significantly from the actual cash generated by business operations during the period. Which financial statement section specifically measures the cash actually generated from the core operating activities of the business? A. Cash flow from investing. B. Retained earnings statement. C. Cash flow from financing. D. Cash flow from operations. Can you guess the answer? Correct answer. D. Cash flow from operations. Explanation. Option D is correct because cash flow from operations measures actual cash generated from core business activities, adjusting net income for non-cash items, and working capital changes. Option A is incorrect because cash flow from investing captures cash movements related to purchasing or selling long-term assets like property and equipment, not daily operational activities. Option B is incorrect because the retained earnings statement shows accumulated profits not distributed as dividends, an accounting concept, rather than a measure of actual cash generation. Option C is incorrect because cash flow from financing reflects cash movements from borrowing, repaying debt, issuing stock or paying dividends, not revenue-generating operating activities of the business. Net income and cash are not the same thing. This question highlights that difference. The cash flow statement has 3 sections: operations, investing, and financing. Cash flow from operations measures cash actually generated by core business activities. It starts with net income and adjusts for non-cash items and working capital changes. Investing cash flows track purchases and sales of long-term assets, equipment, buildings, investments. Financing cash flows cover borrowing, repaying debt, issuing stock, paying dividends. The retained earnings statement shows accumulated profits, an accounting concept, not a cash measure. Here's a WGU C214 OA exam tip for you. When asked specifically about cash from daily business activities, the answer is cash flow from operations. Quick recall, hook, operations equal sign, operating the business equal sign, core cash generation. 12. When calculating cash flow from operations using the indirect method, an analyst starts with net income and must adjust for depreciation expense that appears on the income statement. Why must depreciation expense be added back to net income when determining the actual cash generated by operations? A. Depreciation is a non-cash expense. B. Depreciation represents future cash needs. C. Depreciation increases tax payments. D. Depreciation reduces asset values permanently. What do you think is the answer? Correct answer, A. Depreciation is a non-cash expense. Explanation. Option A is correct because depreciation expense reduces net income on accounting statements, but does not represent an actual outflow of cash during the period, requiring adjustment. Option B is incorrect because depreciation allocates past asset costs over time, rather than representing future cash requirements. The cash outflow occurred when the asset was originally purchased. Option C is incorrect because depreciation actually decreases taxable income and therefore reduces tax payments, providing a tax shield benefit rather than increasing tax obligations. Option D is incorrect because while depreciation reflects declining book values, this accounting treatment does not explain why the non-cash expense must be added back for cash flow purposes. Why add depreciation back to net income when calculating operating cash flow? Because depreciation is a non-cash expense. When a company records depreciation, they reduce net income on paper, but no cash actually leaves the building. The cash left when they bought the asset years ago. Depreciation just spreads that original cost across the asset's useful life for accounting purposes. Since depreciation lowered net income without affecting cash, we add it back to see actual cash generated. Depreciation doesn't represent future cash needs. The cash was spent in the past. It actually reduces taxes since it lowers taxable income. Here's a WGU C214 OA exam tip for you. When asked why depreciation is added back in cash flow calculations, the answer is always that it's a non-cash expense. Quick recall, hook. Depreciation equal sign deducted but no cash departed. 13. A company's accounts receivable balance increased substantially from last year to this year, indicating customers purchased on credit but have not yet paid cash. When calculating cash flow from operations, how should this increase in accounts receivable be treated to accurately reflect actual cash received? A. Added to net income. B. Ignored in calculations. C. Multiplied by tax rate. D. Subtracted from net income. What do you think is the answer? Correct answer, D. Subtracted from net income. Explanation. Option D is correct because an increase in accounts receivable means the company recognized revenue but collected less cash than sales reported, requiring a subtraction to reflect actual cash. Option A is incorrect because adding would overstate cash flow. Increased receivables indicate revenue was recorded on credit without corresponding cash collection from customers during the period. Option B is incorrect because changes in operating accounts directly affect the difference between net income and actual cash flow, making these adjustments essential for accurate analysis. Option C is incorrect because the tax rate adjustment applies to calculating tax expense or shields, not to adjusting for timing differences between revenue recognition and cash collection. If accounts receivable increases, what does that mean for cash flow? You subtract it from net income. Here's why. Higher receivables mean the company made sales and booked revenue, but customers haven't paid yet. Revenue hit the income statement, but cash didn't hit the bank. Net income is overstated relative to actual cash collected, so we subtract the increase to get back to real cash. Think of it this way. You sold products, but you're still waiting for the check. The tax rate adjustment is for calculating taxes, not for this kind of timing difference. Changes in working capital accounts are never ignored in cash flow analysis. Here's a WGU C214 OA exam tip for you. Increases in current assets like receivables and inventory reduce operating cash flow. Increases in current liabilities like payables increase it. Quick recall hook. Receivables up = received less cash = subtract. 14. A retail company significantly increased its inventory levels during the year in anticipation of holiday sales. When preparing the statement of cash flows, this increase in inventory should be recognized as having which effect on the company's cash position for the period? A. Outflow of cash. B. Inflow of cash. C. No effect on cash. D. Increase in revenue. What do you think is the answer? Correct answer, A. Outflow of cash. Explanation: option A is correct because increasing inventory requires using cash to purchase goods, representing a cash outflow, even though the expense is not yet recognized on the income statement. Option B is incorrect because purchasing more inventory consumes cash rather than generating it. Cash flows out of the company to acquire additional goods for future sale. Option C is incorrect because any change in operating asset accounts affects cash flow. The cash used to purchase inventory reduces available cash even before the goods are sold. Option D is incorrect because inventory purchases do not generate revenue. Revenue is recognized only when inventory is sold to customers, which is a separate and subsequent transaction. A retail company increased inventory for holiday sales. What happened to cash? It flowed out. Buying inventory requires paying suppliers. Cash leaves the company, even though the expense won't show up on the income statement until those goods are sold. This is why cash flow analysis matters. You can have great profit potential sitting in your warehouse but be broke. Higher inventory means more cash tied up in goods. This is a use of cash, not a source. It doesn't generate revenue until you sell it. Here's a WGU C214 OA exam tip for you. Increasing inventory is always a cash outflow. You spent money to buy stuff that's sitting on shelves. Quick. Recall hook. Inventory up = cash. Invested = outflow. 15. A manufacturing firm negotiated extended payment terms with suppliers, resulting in higher accounts payable balances compared to the prior year. When analysing cash flow from operations, this increase in accounts payable indicates which type of effect on the company's cash during the period. A. Cash outflow occurred. B. Asset purchase made. C. Cash inflow effect. D. Revenue is recognised. Can you guess the answer? Correct answer, C. Cash inflow effect. Explanation: option C is correct because increased accounts payable means the company received goods or services but retained cash by delaying payment, effectively providing a source of cash. Option A is incorrect because higher payables indicate the company paid out less cash than expenses recognized, preserving rather than expending cash during the reporting period. Option B is incorrect because accounts payable relates to operating liabilities for goods and services received, not capital asset purchases, which appear in the investing section. Option D is incorrect because accounts payable represents amounts owed to suppliers for purchases, not revenue transactions which involve collecting from customers for sales made. Now the opposite situation. Accounts payable went up because the company negotiated longer payment terms with suppliers. What does that mean for cash? It's effectively a source of cash, a cash inflow effect. The company received goods and services but kept its cash longer by delaying payment. They got the benefit without paying yet. Higher payables mean the company is temporarily using supplier money. It's like an interest-free loan. This preserves cash, which is why increases in payables are added in operating cash flow calculations. Accounts payable is an operating liability, not an investing item. Here's a WGUC 214 OA exam tip for you. Increases in current liabilities, like accounts payable, represent cash preserved. The company owes money, but kept its cash. Quick recall hook. Payables up equal sign. Paid less equal sign cash preserved. 16. An investor has the option of receiving a significant sum of money today or waiting 5 years to receive the identical amount. According to fundamental finance principles, why would the investor strongly prefer to receive the money immediately rather than waiting for the future payment? A. Future money has more purchasing power. B. Banks do not accept future deposits. C. Inflation only affects past transactions. D. Present money is worth more than future money. Do you know the answer? Correct answer, D. Present money is worth more than future money. Explanation. Option D is correct because the time value of money principle states that money available today has greater value than identical amounts in the future due to earning potential. Option A is incorrect because inflation typically reduces purchasing power over time, meaning future money generally buys less than the same amount today, not more as this option suggests. Option B is incorrect because banks accept deposits at any time. The preference for immediate money relates to investment opportunity and inflation risk, not banking deposit restrictions. Option C is incorrect because inflation affects future purchasing power by reducing what money can buy over time, which is one reason present money is valued more than future money. This is the time value of money, probably the most fundamental concept in finance. Would you rather have $1 today or $1 in 5 years? Today, obviously. Present money is worth more than future money. 3 reasons. You can invest today's money and earn returns. Inflation will erode purchasing power over time, and there's always risk you won't actually receive the future payment. $1 today can become more than $1 tomorrow through investment. $1 tomorrow might buy less due to inflation, and a promised dollar might never arrive. Here's a WGUC 214 OA exam tip for you. Whenever a question asks why present money is preferred, remember it's about investment opportunity, inflation, and risk. Quick recall hook. Time equal sign value equal sign. Today beats tomorrow. 17. A financial analyst is determining the appropriate rate to use when evaluating future cash flows from a proposed investment project. This rate reflects compensation for waiting, expected inflation, and the uncertainty of receiving promised payments. Which components combine to form this discount rate used in time value calculations? A. Risk-free rate plus inflation plus risk premium. B. Tax rate plus depreciation rate. C. Revenue growth minus expense growth. D. Asset turnover times profit margin. Do you know the answer? Correct answer, A. Risk-free rate plus inflation plus risk premium. Explanation. Option A is correct because the nominal discount rate combines the real risk-free rate for compensation of waiting, expected inflation for purchasing power loss, and risk premium for uncertainty. Option B is incorrect because tax and depreciation rates relate to income calculations and asset accounting, not the components that determine the rate at which money changes value. Option C is incorrect because revenue and expense growth rates measure business performance trends, not the fundamental factors that determine appropriate discount rates for valuation purposes. Option D is incorrect because asset turnover and profit margin are financial ratios measuring operational efficiency and profitability, unrelated to discount rate component determination. What makes up a discount rate? The question describes compensation for waiting, expected inflation, and uncertainty. Those are the three components: risk-free rate, inflation premium, and risk premium. The risk-free rate compensates for waiting, the pure time value of delaying consumption. The inflation premium compensates for expected purchasing power loss. The risk premium compensates for uncertainty, the chance you won't get paid. Add them together. Risk-free rate plus inflation plus risk premium equals the nominal discount rate. Tax and depreciation rates are accounting concepts. Revenue and expense growth measure business performance. Asset turnover and profit margin are efficiency ratios. None of those build a discount rate. Here's a WGUC 214 OA exam tip for you. Discount rate equals compensation for time plus inflation plus risk. Quick recall hook. Discount equals time plus inflation plus risk. 18. A company expects to receive a large payment from a customer in 3 years and wants to determine what this future payment is worth in today's terms for financial planning purposes. Which time value of money calculation would transform this expected future receipt into its current equivalent value? A. Future value calculation. B. Internal rate of return. C. Present value calculation. D. Payback period analysis. Do you know the answer? Correct answer: C. Present value calculation. Explanation. Option C is correct because present value calculations discount future cash flows back to their current equivalent, determining what a future sum is worth today at a given rate. Option A is incorrect because future value calculations move present amounts forward in time, showing what current money will grow to, the opposite of what this scenario requires. Option B is incorrect because internal rate of return calculates the percentage return that makes net present value equal to 0, not the current value of a single future cash flow. Option D is incorrect because payback period analysis determines how long until an investment recovers its cost, not the present equivalent value of a future cash receipt. The company wants to know what a future payment is worth today. That's a present value calculation. Present value answers the question, what is a future amount worth in today's dollars? You're discounting backward in time. Future value does the opposite. It projects what today's money will grow to. Internal rate of return calculates the rate where NPV equals 0, a different purpose entirely. Payback period just counts how long until you recover your initial investment, ignoring time value. Here's a WGUC 214 OA exam tip for you. If the question asks what a future amount is worth today, it's present value. If it asks what today's amount will become, it's future value. Quick recall hook, present equal sign, pull back to today, future equal sign, push forward to later. 19. An employee is planning for retirement and wants to estimate how much their current savings will grow over the next 30 years, assuming earnings are reinvested and generate additional returns over time. Which concept describes this growth phenomenon, where earnings themselves generate future earnings? A. Simple interest accumulation. B. Compound interest growth. C. Linear growth projection. D. Inflation adjustment factor. Can you guess the answer? Correct answer: B. Compound interest growth. Explanation. Option B is correct because compound interest occurs when earnings are reinvested and generate their own returns, causing money to grow exponentially rather than linearly over time. Option A is incorrect because simple interest calculates returns only on the original principal amount, without reinvesting earnings to generate additional returns, as described in the scenario. Option C is incorrect because linear growth implies constant, absolute increases each period, whereas compounding produces accelerating growth as the earning base expands with reinvested returns. Option D is incorrect because inflation adjustment accounts for purchasing power changes over time, not the growth mechanism where investment earnings generate additional future earnings. The employee wants to see how their savings will grow over 30 years with earnings reinvested. That's compound interest. Compounding means your earnings generate their own earnings. Year 1, you earn interest on your principal. Year 2, you earn interest on principal plus the interest you already earned. Year 3, you earn on that larger amount. And so on, the growth accelerates because your base keeps expanding. Simple interest only pays on the original principal, same dollar amount each year, no reinvestment. Linear growth is constant. Add the same amount each period. Inflation adjustment corrects for purchasing power, not the growth mechanism. Here's a WGUC 214 OA exam tip for you. When you see interest on interest or earnings reinvested, that's compounding. Quick recall hook. Compound equal sign, cumulative equal sign earnings, earning more earnings. 20. A retiree receives identical monthly pension payments deposited into their bank account at the end of each month for the duration of their retirement. This consistent payment pattern, with equal amounts paid at regular intervals over a fixed period, is best described by which financial term? A. Perpetuity stream. B. Uneven cash flow series. C. Ordinary annuity. D. Lump sum payment. Can you guess the answer? Correct answer, C. Ordinary annuity. Explanation: Option C is correct because an ordinary annuity consists of equal periodic payments made at the end of consecutive periods over a fixed duration, matching the described pension arrangement. Option A is incorrect because a perpetuity continues indefinitely without a fixed end date, whereas the pension payments described have a finite duration limited to the retiree's lifetime. Option B is incorrect because uneven cash flows vary in amount between periods, while the scenario specifically describes identical payments made consistently each month without variation. Option D is incorrect because a lump sum is a single one-time payment rather than the series of equal periodic payments described in this pension payment arrangement scenario. Equal monthly payments at the end of each month for a fixed period. That's an ordinary annuity. An annuity is a series of equal payments at regular intervals. Ordinary means payments come at the end of each period. Fixed duration is key. It has a defined stopping point. A perpetuity is similar but never stops. It goes on forever. The pension described has a finite duration. Uneven cash flows vary in amount, but this scenario specifically says identical payments. A lump sum is one single payment, not a series. Here's a WGUC 214 OA exam tip for you. Equal payments, regular intervals, fixed period, payments at period end. That's an ordinary annuity. If it lasts forever, it's a perpetuity. Quick recall hook. Ordinary annuity, equal sign equal, end of period eventually ends. 21. A financial analyst has calculated various performance metrics for a company, but recognizes that individual ratios provide limited insight when viewed in isolation. According to best practices in financial analysis, against which standard should current year ratios primarily be compared to determine whether performance is improving or deteriorating? A. Random industry averages. B. The same firm's historical ratios. C. Government benchmark standards. D. Theoretical optimal value. What do you think is the answer? Correct answer, B. The same firm's historical ratios. Explanation: Option B is correct because trend analysis comparing current ratios to the same firm's prior years reveals whether performance is improving, stable, or declining over time. Option A is incorrect because meaningful comparison requires carefully selected peer groups or industry averages, not random industry statistics that may include unrelated business types. Option C is incorrect because governments do not establish benchmark ratio standards for private businesses. Comparison standards come from the firm's history, peers, or internal goals. Option D is incorrect because theoretical optimal values rarely exist for financial ratios. Appropriate targets depend on industry characteristics, competitive position, and company strategy. Ratios in isolation tell you almost nothing. A current ratio of 1.5 equal, is that good? Bad? You can't know without context. The best comparison standard is the same firm's historical ratios. This is trend analysis. Compare this year's current ratio to last year's and the year before. Are things improving? Declining? Staying flat? That trajectory matters more than any single number. Random industry averages mix unrelated businesses, useless for meaningful comparison. Governments don't set ratio benchmarks for private companies. And theoretical optimal values? They rarely exist. What's optimal depends on industry, strategy, and competitive position. Here's a WGUC 214 OA exam tip for you. When asked how to evaluate whether ratios are improving or deteriorating, the answer is comparing to the firm's own history. Quick recall hook. Trend equals sign track over time equals sign same firm's past. 22. When evaluating whether a retail company is managing inventory more efficiently than competitors, an analyst gathers ratio data from several similar retailers operating in the same market segment. This comparison approach, examining performance relative to peer companies, represents which type of ratio analysis methodology? A. Cross-sectional analysis methodology. B. Trend analysis methodology. C. Internal goal monitoring. D. Sensitivity analysis methodology. Do you know the answer? Correct answer, A. Cross-sectional analysis methodology. Explanation: Option A is correct, because cross-sectional analysis compares a firm's ratios against peer groups, competitors, or industry averages at the same point in time to assess relative performance. Option B is incorrect because trend analysis examines the same firm's ratios across multiple time periods to identify patterns, not comparison against other companies at one point. Option C is incorrect because internal goal monitoring compares actual performance against specific targets set by management, not against external peer company performance metrics. Option D is incorrect because sensitivity analysis tests how changes in input assumptions affect outcomes, not how a firm's performance compares to competitor companies. Now we're comparing against competitors instead of time. The analyst gathers ratio data from several similar retailers in the same market segment. That's cross-sectional analysis. Cross-sectional means comparing across different companies at the same point in time. How does your inventory turnover compare to competitors? Better or worse than the industry average? Trend analysis looks backward at your own company over time. Different purpose. Internal goal monitoring compares actual performance to targets you set yourself. Sensitivity analysis tests how assumptions affect outcomes. Nothing to do with competitor comparison. Here's a WGUC 214 OA exam tip for you. Comparing against peers or competitors at the same time equals cross-sectional analysis. Comparing your own company over time equals trend analysis. Quick recall hook. Cross-sectional equals sign, cross companies equals sign compare peers. 23. An analyst preparing a comprehensive ratio comparison between two competing firms discovers they use different depreciation schedules for similar equipment, causing reported asset values to differ significantly. This situation illustrates which common challenge that must be addressed before meaningful ratio comparisons can be conducted. A. Market timing differences. B. Currency translation issues. C. Seasonal demand variations. D. Accounting method differences. What do you think is the answer? Correct answer: D. Accounting method differences. Explanation. Option D is correct because different accounting choices like depreciation methods affect reported figures, requiring analysts to recast financial statements before making meaningful ratio comparisons. Option A is incorrect because market timing refers to when firms release financial reports, not the underlying accounting methods that determine how transactions are recorded and reported. Option B is incorrect because currency translation applies to multinational operations reporting in different currencies, not domestic firms using different depreciation schedules for similar assets. Option C is incorrect because seasonal demand affects when revenues and costs occur during the year, not the accounting policies that determine how assets are depreciated over time. Here's a real problem analysts face. Two competing firms use different depreciation schedules for similar equipment. One uses straight line over 10 years, another uses accelerated over 5. Their asset values look completely different, even though the underlying equipment is identical. That's an accounting method difference. Before you can meaningfully compare ratios, you need to adjust for these differences. Market timing is about when reports come out. Not relevant here. Currency translation matters for multinational operations, not domestic firms with different depreciation. Seasonal variations affect when revenues occur, not how assets are recorded. Here's a WGUC 214 OA exam tip for you. When a question mentions different depreciation methods, inventory valuation methods, or other accounting choices affecting comparability, the answer involves accounting method differences. Quick recall hook. Different methods equal sign, different numbers equal sign. Adjust before comparing. 24. A manufacturing company has substantial fixed costs from factory equipment and facilities that do not change regardless of production volume. When sales increase, this cost structure causes operating income to rise proportionally faster than the sales increase. Which concept measures how sensitive operating income is to changes in sales revenue? A. Degree of operating leverage. B. Debt to equity ratio. C. Current ratio measurement. D. Inventory turnover rate. Do you know the answer? Correct answer: A. Degree of operating leverage. Explanation. Option A is correct because the degree of operating leverage measures how much operating income changes in response to sales changes, influenced by the proportion of fixed versus variable costs. Option B is incorrect because the debt to equity ratio measures financial leverage from borrowing, not the operational sensitivity of earnings to sales changes from fixed cost structure. Option C is incorrect because the current ratio measures short-term liquidity by comparing current assets to current liabilities, unrelated to operating income sensitivity to sales changes. Option D is incorrect because inventory turnover measures how efficiently a company sells and replaces inventory, not how operating income responds to changes in sales volume. A manufacturing company has high fixed costs from factory equipment. Those costs stay the same whether they make 1 unit or 1 million. When sales go up, operating income rises faster than sales. Why? Because fixed costs are spread over more units. This sensitivity is measured by the degree of operating leverage. High fixed costs mean high operating leverage. Small changes in sales create large swings in operating income. The debt to equity ratio measures financial leverage from borrowing. Different concept. Current ratio measures liquidity. Inventory turnover measures efficiency. None of those capture how operating income responds to sales changes. Here's a WGUC 214 OA exam tip for you. When operating income changes proportionally more than sales due to fixed costs, that's operating leverage. Quick recall hook. Operating leverage equals sign. Operating income sensitivity equals sign fixed costs driving swings. 25. During a comprehensive firm analysis, an analyst recognizes that strong financial ratios alone do not guarantee future success, because companies also face threats from economic cycles, technological disruption, and competitive pressures. These threats originating from outside the company's direct control are categorized as which type of risk in business analysis? A. External environmental risks. B. Internal operational risks. C. Accounting measurement risks. D. Management agency risks. Can you guess the answer? Correct answer: A. External environmental risks. Explanation. Option A is correct because external risks include macroeconomic conditions, competitive forces, technological changes, and demographic shifts that affect the firm from outside its direct control. Option B is incorrect because internal risks arise from within the organisation, such as financial viability, innovation willingness, and corporate culture, not from external market forces. Option C is incorrect because accounting measurement risks relate to how transactions are recorded and reported on financial statements, not threats from the external business environment. Option D is incorrect because management agency risks involve conflicts between manager and shareholder interests, an internal governance issue rather than external environmental threats. Strong ratios don't guarantee success. A company can have perfect financials and still get crushed by a recession, disrupted by new technology, or outmaneuvered by competitors. These are external environmental risks, threats from outside the company's control. Economic cycles, technological disruption, competitive pressures, regulatory changes, all external. Internal operational risks come from within, management problems, culture issues, innovation failures. Accounting measurement risks relate to how numbers are recorded. Agency risks involve conflicts between managers and owners. The question specifically mentions threats from outside, which points to external risks. Here's a WGUC 214 OA exam tip for you. When risks come from economy, competition, technology, or regulation, force is outside company control. That's external environmental risk. Quick recall hook. External =, environment, =, economy, competition, technology. 26. A corporation issues bonds to fund a major expansion project, but these bonds are not backed by any specific company assets as collateral. If the company defaults on its debt payments, bondholders cannot claim any particular property. Which type of bond best describes this unsecured debt arrangement that relies solely on the issuer's creditworthiness? A. Mortgage bonds. B. Debentures. C. Treasury bonds. D. Convertible bonds. Do you know the answer? Correct answer: B. Debentures. Explanation. Option B is correct because debentures are unsecured bonds that are not backed by specific collateral, making them riskier and dependent entirely on the issuer's overall creditworthiness and reputation. Option A is incorrect because mortgage bonds are secured by specific real estate property as collateral, providing bondholders a claim to that asset if the company defaults. Option C is incorrect because Treasury bonds are issued by the federal government and backed by the government's taxing authority, not by corporations seeking expansion financing. Option D is incorrect because convertible bonds have a feature allowing conversion to stock shares, but this describes a bond feature rather than its security status. The company issues bonds with no specific assets as collateral. If they default, bondholders can't seize any particular property. That's a debenture, an unsecured bond. Debentures rely entirely on the issuer's creditworthiness and reputation, no collateral backing them up. This makes them riskier than secured bonds, so they typically pay higher interest rates. Mortgage bonds are the opposite, secured by real estate. If the company defaults, bondholders have a claim on that property. Treasury bonds are government securities, not corporate. Convertible bonds can be exchanged for stock, but that's a feature, not a security classification. Here's a WGUC 214 OA exam tip for you. Unsecured corporate bonds with no collateral are called debentures, Secured by real estate means mortgage bonds, quick recall hook. Debenture =sign debt with no backing, =sign unsecured. 27. A credit rating agency has assigned a rating of BB to a company's newly issued bonds, indicating that analysts have concerns about the company's ability to meet its debt obligations under adverse economic conditions. Based on standard bond rating classifications, how would investors categorize these bonds in terms of investment quality? A. Investment-grade securities. B. Risk-free instruments. C. Government-backed securities. D. Junk bonds. What do you think is the answer? Correct answer, D. Junk bonds. Explanation. Option D is correct, because bonds rated BB or below are classified as junk bonds or high-yield bonds, considered too risky to qualify as investment-grade securities suitable for conservative investors. Option A is incorrect because investment-grade bonds must have ratings of BBB or higher. A BB rating falls below this threshold and indicates speculative quality with higher default risk. Option B is incorrect because risk-free instruments typically refer to government securities backed by the taxing authority, not corporate bonds with speculative ratings from credit agencies. Option C is incorrect because government-backed securities are issued by federal, state, or local governments, not private corporations subject to credit rating agency evaluations for default risk. A BB rating from a credit agency. What does that mean? It means junk bond territory. Bond ratings use letters. AA is the highest, then AAA, BBB. Anything BBB or above is investment grade, considered relatively safe for conservative investors. Below BBB, that's BBBCC and lower, is junk bond territory, also called high-yield bonds. BB indicates concerns about the company's ability to meet obligations in bad times. More risk means higher yields to compensate investors. Investment grade requires BBB minimum. Risk-free applies to government securities. Government-backed means treasury bonds, not corporate bonds with credit ratings. Here's a WGUC 214 OA exam tip for you. BBB or above equals investment grade. Below BBB, including BB, equals junk bonds or high-yield bonds, quick recall hook. BB =sign below the bar =sign junk. 28. An investor purchases bonds that include a special provision allowing the bondholder to exchange each bond for a predetermined number of common stock shares at any time before maturity. This feature provides potential upside if the company's stock price rises significantly. Which bond characteristic does this exchange provision represent? A. Convertibility feature. B. Subordination clause. C. Mortgage backing. D. Municipal tax exemption. Can you guess the answer? Correct answer. A. Convertibility feature. Explanation. Option A is correct, because convertibility allows bondholders to exchange their bonds for a specified number of common stock shares, providing equity participation potential if stock prices increase. Option B is incorrect because a subordination clause indicates that certain bondholders have lower priority claims to assets than other creditors during liquidation, not stock exchange rights. Option C is incorrect because mortgage backing refers to specific real estate collateral, securing a bond, providing asset protection rather than equity conversion opportunities for investors. Option D is incorrect because municipal tax exemption is a benefit of bonds issued by local governments where interest payments are exempt from federal taxation, unrelated to conversion rights. The bondholder can exchange bonds for common stock shares at any time before maturity. That's a convertibility feature. Convertible bonds give you a choice. Keep collecting interest payments as a bondholder, or convert to stock if the share price rises high enough to make conversion profitable. It's the best of both worlds: downside protection from the bond, upside potential from the stock. Subordination is about payment priority during bankruptcy. Who gets paid first? Mortgage backing means real estate collateral. Municipal tax exemption applies to state and local government bonds. None of those involve exchanging debt for equity. Here's a WGUC 214 OA exam tip for you. When bondholders can exchange bonds for stock shares, that's convertibility. Quick recall hook. Convertible equal sign. Convert to stock equal sign exchange option. 29. A financial analyst explains to new employees that certain government securities are considered virtually risk-free because they are backed by the full faith and taxing power of the federal government. These securities range from short-term instruments maturing in months to long-term bonds maturing in 30 years. Which category of securities does this description characterize? A. Corporate debentures. B. Municipal bonds. C. Treasury securities. D. Eurodollar bonds. Can you guess the answer? Correct answer, C. Treasury securities. Explanation: option C is correct because Treasury securities are issued by the federal government and considered risk-free investments since they are backed by the government's full faith and taxing power. Option A is incorrect because corporate debentures are unsecured bonds issued by private companies, carrying significant default risk depending on the issuing corporation's financial health. Option B is incorrect because municipal bonds are issued by state and local governments for infrastructure projects, not by the federal government with its unique taxing authority backing. Option D is incorrect because Eurodollar bonds are corporate bonds issued in foreign markets payable in dollars, representing private debt rather than government-backed securities. Securities backed by the full faith and taxing power of the federal government. Virtually risk-free. Range from short-term to 30 years. That's Treasury securities. The US government has never defaulted on its debt obligations. It can always raise taxes or print money to pay bondholders. That's why Treasuries are considered the risk-free benchmark in finance. Corporate debentures are unsecured company debt. Definitely not risk-free. Municipal bonds come from state and local governments, not federal. Eurodollar bonds are corporate bonds issued internationally in dollars. Only Treasury securities carry that federal government backing. Here's a WGUC 214 OA exam tip for you. Federal government backing with full faith and credit means Treasury securities. That's your risk-free rate in finance calculations. Quick recall hook. Treasury equal sign trust, the government equal sign risk-free rate. 30. A large multinational corporation needs to raise several $billion, but finds that borrowing such large amounts from commercial banks would be impractical and expensive due to intermediary costs. Instead, the company decides to issue debt securities directly to investors in the capital markets. What primary advantage does issuing bonds provide compared to obtaining traditional bank financing? A. Guaranteed government backing. B. Automatic stock conversion rights. C. Federal tax exemption benefits. D. Elimination of intermediary costs. Do you know the answer? Correct answer, D. Elimination of intermediary costs. Explanation. Option D is correct because issuing bonds allows corporations to borrow directly from investors in capital markets, bypassing bank intermediaries who charge spreads between their borrowing and lending rates. Option A is incorrect because corporate bonds do not receive government backing. Only Treasury securities issued by the federal government carry full faith and credit guarantees from the government. Option B is incorrect because most corporate bonds do not automatically include stock conversion rights. Convertibility is a special feature added to some bonds at the issuer's discretion. Option C is incorrect because corporate bonds generally do not provide federal tax exemption benefits. Tax-exempt status primarily applies to municipal bonds issued by state and local governments. A multinational needs billions of dollars. Banks would be impractical and expensive, all those intermediary costs, so they issue bonds directly to investors. The advantage, eliminating intermediary costs. When you borrow from a bank, the bank borrows at one rate and lends to you at a higher rate. That spread is their profit and your cost. By issuing bonds directly in capital markets, companies bypass the middleman. They borrow straight from investors. Corporate bonds don't get government backing, only treasuries do. Convertibility is an optional feature, not standard. Tax exemption is for municipal bonds, not corporate. Here's a WGUC 214 OA exam tip for you. The main advantage of issuing bonds versus bank loans is cutting out the bank as intermediary, direct access to capital markets. Quick recall hook. Bonds bypass banks, equal sign. Direct to investors, equal sign, lower costs. 31. An investment analyst is determining the intrinsic value of a company's common stock by estimating all future dividend payments the company will or make to shareholders and calculating their present value using an appropriate discount rate. This approach reflects which fundamental principle underlying equity valuation methodologies? A. Book value equals market value. B. Historical prices predict future prices. C. Stock value equals present value of dividends. D. Market capitalization determines worth. Do you know the answer? Correct answer, C. Stock value equals present value of dividends. Explanation. Option C is correct because the intrinsic value of stock equals the present value of expected future cash flows to shareholders, which primarily consists of dividends discounted at appropriate rates. Option A is incorrect because book value represents historical accounting values, while market value reflects investor expectations about future performance, and these values frequently differ substantially. Option B is incorrect because historical stock prices do not reliably predict future prices. Stock valuation depends on expected future cash flows and risk factors rather than past price patterns. Option D is incorrect because market capitalization measures total outstanding shares times current price, a result of valuation rather than the fundamental principle driving that valuation. How do you value a stock? The fundamental principle, stock value equals the present value of all future dividends. Estimate every dividend the company will ever pay, discount each one back to today, add them up, that's intrinsic value. This is the foundation of equity valuation. Book value is just accounting. Historical costs minus depreciation. It rarely equals market value. Past prices don't predict future prices either. Markets look forward, not backward. Market capitalization tells you current size, but it's a result of valuation, not the principle behind it. Here's a WGUC 214 OA exam tip for you. The fundamental principle of stock valuation is that stock value equals the present value of expected future dividends or cash flows to shareholders. Quick recall hook. Stock equal sign sum of future dividends equal sign discounted today. 32. A company consistently pays dividends that grow at a stable rate each year, and analysts expect this pattern to continue indefinitely into the future. When valuing this company's stock, which assumption must hold true for the Gordon growth model to produce mathematically valid results that investors can rely upon? A. Dividends must decrease over time. B. Stock price must equal book value. C. Growth rate must exceed required return. D. Required return must exceed growth rate. Can you guess the answer? Correct answer, D. Required return must exceed growth rate. Explanation. Option D is correct because the Gordon model requires the required rate of return to exceed the dividend growth rate. Otherwise, the formula produces mathematically undefined or negative values. Option A is incorrect because the Gordon model assumes dividends grow at a positive constant rate indefinitely. Decreasing dividends would violate the model's fundamental assumptions about cash flows. Option B is incorrect because the model calculates intrinsic value based on future dividend streams, which typically differs from book value that reflects historical accounting measurements. Option C is incorrect because if the growth rate exceeded the required return, the model would produce infinite or negative stock values, which are economically meaningless for valuation. The Gordon growth model values stocks with stable, perpetual dividend growth. But there's a critical assumption. The required return must exceed the growth rate. If R is your required return and G is the growth rate, you need R greater than G. Why? The formula is D1 divided by R minus G. If G equals or exceeds R, you're dividing by 0 or a negative number, mathematically meaningless. You'd get infinite or negative stock prices, which makes no sense economically. Dividends growing faster than your required return forever would mean infinite value. Impossible in reality. Here's a WGUC 214 OA exam tip for you. For the Gordon model to work mathematically, required return must exceed growth rate, R greater than G. Quick recall hook. Gordon needs R greater than G equal sign. Required beats growth. 33. An investor researches a company with excellent management, strong earnings, and dominant market position, but discovers that other investors have already recognized these qualities and bid up the stock price accordingly. Despite being a quality company, why might this stock represent a poor investment opportunity for the new investor? A. The stock price already reflects value. B. Quality companies never pay dividends. C. Strong earnings reduce stock prices. D. Market leaders always decline eventually. Do you know the answer? Correct answer. A. The stock price already reflects value. Explanation. Option A is correct because if a stock's price already reflects all positive qualities, purchasing at this high price leaves little room for gains since intrinsic value equals current price. Option B is incorrect because many quality companies do pay dividends, and dividend payments actually contribute positively to total shareholder returns over time for investors. Option C is incorrect because strong earnings typically support higher stock prices through increased dividend capacity and growth potential, not to price reductions as suggested in this option. Option D is incorrect because market leadership does not guarantee decline. Many dominant companies sustain their positions for extended periods while continuing to create shareholder value. Great company, excellent management, strong earnings, dominant market position. But other investors already noticed all this and bid up the price. The stock might still be a poor investment. Why? The price already reflects the value. If intrinsic value equals current price, there's no bargain. You're paying fair value for a great company. Your returns will be average at best. The opportunity was buying before everyone else noticed. A quality company at a quality price isn't necessarily a good investment. You need quality at a discount. Here's a WGUC 214 OA exam tip for you. Even excellent companies can be poor investments if their stock price already reflects all the good news. Price matters as much as quality. Quick recall hook. Price reflects value equal sign. No bargain equal sign. No edge. 34. A company issues securities that pay fixed dividend payments indefinitely without a maturity date, have priority over common shareholders for dividend payments, but do not provide voting rights on corporate matters. These securities combine characteristics of both debt instruments and equity ownership. Which type of security matches this description? A. Convertible bonds. B. Treasury notes. C. Common stock. D. Preferred stock. Can you guess the answer? Correct answer, D. Preferred stock. Explanation. Option D is correct because preferred stock is a hybrid security paying fixed dividends indefinitely, ranking above common stock for dividends and liquidation, but typically lacking voting rights. Option A is incorrect because convertible bonds are debt instruments with maturity dates that can be exchanged for common stock, not equity securities paying perpetual fixed dividends. Option B is incorrect because Treasury notes are government debt securities with fixed maturity dates and interest payments, not perpetual equity securities issued by corporations. Option C is incorrect because common stock provides voting rights and variable dividends based on company performance, unlike preferred stock with fixed dividends and no voting rights. Fixed dividends paid indefinitely, no maturity date. Priority over common stock. No voting rights, that's preferred stock. Preferred stock is a hybrid, part debt, part equity. Like bonds, it pays fixed amounts regularly. Like stock, it has no maturity and represents ownership. Preferred shareholders get paid before common shareholders, but after bondholders, they typically can't vote on corporate matters. Convertible bonds are debt with a maturity date and conversion option. Treasury notes are government debt with fixed terms. Common stock has voting rights and variable dividends. Here's a WGU C214 OA exam tip for you. Fixed dividends, no maturity, no voting, priority over common. That describes preferred stock. Quick recall hook, preferred equals sign, priority dividends equals sign hybrid between debt and equity. 35. A corporation's board of directors decides to skip preferred dividend payments for 2 consecutive years during a financial downturn. When the company's finances recover, management wants to resume paying common stock dividends to shareholders. What must the company do first regarding the missed preferred dividend payments according to typical preferred stock provisions? A. Cancel the missed payments permanently. B. Convert preferred shares to common shares. C. Pay all accumulated preferred dividends first. D. Seek bondholder approval for dividends. Do you know the answer? Correct answer, C. Pay all accumulated preferred dividends first. Explanation. Option C is correct because most preferred stock is cumulative, meaning all missed dividend payments must be paid in full before any common stock dividends can be distributed to shareholders. Option A is incorrect because cumulative preferred stock provisions require payment of all missed dividends. Companies cannot simply cancel accumulated obligations owed to preferred shareholders. Option B is incorrect because skipped dividends do not trigger automatic conversion of preferred shares. Conversion is typically an optional feature exercised at the shareholder's discretion. Option D is incorrect because bondholders receive interest payments separate from dividend decisions. Their approval is not required for the company to resume dividend payments to shareholders. The company skipped preferred dividends for 2 years during a downturn. Now they want to pay common dividends again. What happens first? They must pay all accumulated preferred dividends. Most preferred stock is cumulative. Missed dividends pile up and must be paid before common shareholders see a dime. The company can't just cancel those missed payments. That's the deal with cumulative preferred. Skip dividends don't trigger automatic conversion to common shares. Bondholders aren't involved in dividend decisions. They get interest payments regardless. Here's a WGUC 214 OA exam tip for you. Cumulative preferred stock requires all missed dividends to be paid before any common dividends can be distributed. Quick recall, hook, cumulative equals sign, catch up first equals sign, pay all arrears. 36. An investor holds a portfolio containing stocks from only the airline industry and becomes concerned when fuel prices rise dramatically, negatively impacting all holdings simultaneously. By expanding the portfolio to include stocks from unrelated industries like technology and healthcare, which type of risk can this investor potentially reduce through broader diversification? A. Systematic market risk. B. Interest rate risk. C. Inflation risk. D. Unsystematic company-specific risk. Do you know the answer? Correct answer, D. Unsystematic company-specific risk. Explanation. Option D is correct because unsystematic risk is company or industry-specific risk that can be reduced through diversification by holding assets whose returns are not perfectly correlated with each other. Option A is incorrect because systematic risk affects the entire market and cannot be eliminated through diversification, regardless of how many different assets are included in a portfolio. Option B is incorrect because interest rate risk affects most securities similarly when rates change, representing a systematic factor that diversification across industries cannot eliminate completely. Option C is incorrect because inflation risk impacts purchasing power across all investments broadly, functioning as a systematic economic factor rather than company-specific risk that diversification addresses. An investor holds only airline stocks. Fuel prices spike. Every holding drops simultaneously. That's what happens when you're not diversified. Industry-specific risk hits your whole portfolio. By adding technology and healthcare stocks, the investor reduces unsystematic risk. Unsystematic risk is company or industry-specific. It can be diversified away because different industries respond differently to events. Fuel prices hurt airlines, but might help oil companies. Systematic risk is market-wide, recessions, interest rates, affecting everything. You can't diversify that away. Here's a WGUC 214 OA exam tip for you. Risk that can be reduced through diversification is unsystematic or company-specific risk. Risk affecting the entire market is systematic and can't be diversified. Quick recall hook. Unsystematic =, unique =, diversifiable. 37. A financial analyst calculates that a particular stock has a beta coefficient of 1.5, indicating higher sensitivity to market movements compared to the overall market index. If the market increases by 10%, what does this beta value suggest about the expected price movement of this individual stock? A. The stock will move more than the market. B. The stock will move exactly as the market. C. The stock will move less than the market. D. The stock will move opposite to the market. What do you think is the answer? Correct answer. A. The stock will move more than the market. Explanation. Option A is correct because beta measures sensitivity to market movements. A beta greater than 1 indicates the stock amplifies market changes, moving proportionally more than market returns. Option B is incorrect because moving exactly with the market would require a beta of 1. A beta of 1.5 indicates greater responsiveness to market movements. Option C is incorrect because moving less than the market would require a beta below 1. Higher betas like 1.5 indicate amplified sensitivity to market fluctuations. Option D is incorrect because opposite movement would require a negative beta. Positive betas indicate the stock moves in the same direction as the market, just with different magnitude. Beta of 1.5 means this stock is 50% more sensitive to market movements than the market itself. If the market goes up 10%, expect this stock to go up about 15%. It amplifies market movements. Beta measures systematic risk, how much a stock moves with the overall market. Beta of 1 means the stock moves exactly with the market. Beta below 1 means it moves less. Beta above 1 means it moves more. Negative beta would mean opposite direction, but that's rare. This stock at 1.5 will swing wider than the market in both directions. Here's a WGUC 214 OA exam tip for you. Beta above 1 means more volatile than the market. Beta below 1 means less volatile. Beta = 1 means moves with the market. Quick recall hook. Beta above 1 =, bigger moves = amplified. 38. A portfolio manager uses a widely accepted model to estimate the expected return on a stock investment by considering the risk-free rate, the stock's sensitivity to market movements, and the expected market return premium above the risk-free rate. Which model combines these specific components to calculate the required return investors should expect? A. Gordon growth model. B. Dividend discount model. C. Capital asset pricing model. D. Net present value model. Can you guess the answer? Correct answer, C. Capital asset pricing model. Explanation. Option C is correct because capital asset pricing model calculates expected returns using the risk-free rate plus beta multiplied by the market risk premium, which is market return minus the risk-free rate. Option A is incorrect because the Gordon growth model values stocks using dividends, growth rates, and required returns, not by combining risk-free rates with beta and market premiums. Option B is incorrect because the dividend discount model calculates stock value by discounting expected dividends, not by estimating required returns from risk-free rates and market premiums. Option D is incorrect because net present value calculates the value of project cash flows minus initial investment, a capital budgeting tool rather than a return estimation model. Risk-free rate, the stock sensitivity to market movements, and the market risk premium. Combine those to get expected return. That's the capital asset pricing model, CAPM. The formula, expected return equals risk-free rate plus beta times market risk premium. The market risk premium is market return minus the risk-free rate. CAPM says you should be compensated for time value through the risk-free rate, plus additional compensation for bearing systematic risk proportional to your beta. Gordon growth model values stocks using dividends, different purpose. Dividend discount model also values stocks. NPV evaluates projects. Only CAPM calculates required returns this way. Here's a C214 OA exam tip for you. When you see risk-free rate plus beta times market premium, that's CAPM. Quick recall hook. CAPM equals sign calculate return from risk-free plus beta times premium. 39. An economist explains that certain economic factors, like recessions, interest rate changes, and geopolitical events, affect virtually all stocks in the market, regardless of which companies or industries investors choose for their portfolios. This type of market-wide risk represents which category that investors cannot eliminate regardless of how many securities they own. A. Unsystematic risk. B. Systematic risk. C. Diversifiable risk. D. Company-specific risk. Do you know the answer? Correct answer, B. Systematic risk. Explanation. Option B is correct because systematic risk stems from economy-wide factors affecting all securities simultaneously, and this market risk cannot be diversified away regardless of portfolio composition. Option A is incorrect because unsystematic risk is specific to individual companies or industries and can be reduced through diversification across different unrelated securities. Option C is incorrect because diversifiable risk is another term for unsystematic risk that can be eliminated by holding a well-diversified portfolio across multiple asset types. Option D is incorrect because company-specific risk is a synonym for unsystematic risk affecting individual firms, which investors can reduce by diversifying across many different companies. Recessions, interest rate changes, geopolitical events, these affect all stocks regardless of company or industry. That's systematic risk. You can't escape it by diversifying. Even if you own 1,000 different stocks, a recession hits them all. Systematic risk is market-wide. It's also called non-diversifiable risk or market risk. Unsystematic risk is the opposite, specific to individual companies or industries. A product recall hurts one company. A new competitor threatens one industry. You can diversify those away. Company-specific risk and diversifiable risk are just other names for unsystematic risk. Here's a C214 OA exam tip for you. Market-wide risk that can't be diversified is systematic. Company-specific risk that can be diversified is unsystematic. Quick recall. Hook. Systematic equal sign. System-wide equal sign can't escape. 40. An investment advisor recommends that clients spread their wealth across different asset classes, including stocks, bonds, and real estate, rather than concentrating holdings in a single investment type. This strategy aims to reduce portfolio risk while maintaining reasonable expected returns. What is the primary trade-off investors might experience when implementing extensive diversification? A. Increased transaction costs only. B. Loss of ownership rights. C. Potential for lower portfolio returns. D. Mandatory tax payments. Can you guess the answer? Correct answer, C. Potential for lower portfolio returns. Explanation. Option C is correct because diversification may include lower returning assets to reduce risk, potentially decreasing overall portfolio returns compared to concentrated positions in high-performing investments. Option A is incorrect because while transaction costs may increase with more holdings, the primary trade-off of diversification relates to balancing risk reduction against potentially lower expected returns. Option B is incorrect because diversification does not affect ownership rights. Investors maintain full ownership of all securities, regardless of how many different investments they hold. Option D is incorrect because taxes depend on gains and income generated, not on diversification itself. Spreading investments does not automatically trigger mandatory tax payments. Spread your wealth across stocks, bonds, real estate. Reduce risk while maintaining reasonable returns. What's the trade-off? Potential for lower returns. Diversification might mean including some lower returning assets to reduce overall volatility. If you put everything in your best performing investment, you might earn more, but with much higher risk. Diversification sacrifices some upside potential for stability. Transaction costs might increase with more holdings, but that's secondary. Ownership rights aren't affected. You own what you own. Taxes depend on gains, not how many different things you hold. Here's a WGUC 214 OA exam tip for you. The primary trade-off of diversification is potentially lower returns in exchange for reduced risk. Quick recall, hook. Diversify equal sign, dampen risk equal sign, possibly dampen returns. 41. A company is evaluating whether to invest in new manufacturing equipment that requires a significant initial outlay, but promises to generate positive cash flows over the next 10 years. The finance team calculates the present value of all expected future cash inflows and subtracts the initial investment cost. Which capital budgeting metric does this calculation represent? A. Internal rate of return. B. Net present value. C. Payback period. D. Profitability index. Can you guess the answer? Correct answer, B. Net present value. Explanation: option B is correct, because net present value equals the present value of all future cash flows discounted at the required return minus the initial investment cost, measuring value creation. Option A is incorrect because internal rate of return calculates the discount rate, making net present value equal 0, solving for a percentage return rather than a dollar value measure. Option C is incorrect because payback period measures how long until cumulative cash flows recover the initial investment, ignoring time value of money and cash flows after payback. Option D is incorrect because profitability index divides present value of future cash flows by initial investment, producing a ratio rather than a dollar measure of value creation. Capital budgeting time. The company calculates the present value of future cash inflows, then subtracts the initial investment. That's net present value, NPV. NPV tells you in dollars how much value a project creates. Positive NPV means the project's worth more than it costs. Negative NPV means it destroys value. It's the gold standard of capital budgeting because it directly measures wealth creation. Internal rate of return solves for a percentage, not a dollar amount. Payback just counts how long until you get your money back. Ignores time value entirely. Profitability index gives you a ratio, not absolute dollars. Here's a WGU C214 OA exam tip for you. Present value of cash flows minus initial investment equals NPV. It measures value creation in dollars. Quick, recall hook. NPV equals sign net value created equals sign PV minus cost. 42. A project analyst presents investment results showing that a proposed expansion project would generate returns at a rate that exactly makes the present value of future cash inflows equal to the initial cost. When comparing this calculated percentage return to the company's required rate of return, which metric has the analyst used to evaluate this investment? A. Net present value. B. Profitability index. C. Average accounting return. D. Internal rate of return. What do you think is the answer? Correct answer, D. Internal rate of return. Explanation. Option D is correct because internal rate of return is the discount rate that makes net present value exactly equal to zero, representing the percentage return earned on the invested capital over the project life. Option A is incorrect because net present value calculates dollar value created using a given discount rate, rather than solving for the rate that equates present values of inflows and outflows. Option B is incorrect because profitability index measures the ratio of present value to investment, not the rate that equates future cash flow values to initial outlay. Option C is incorrect because average accounting return uses accounting income rather than cash flows and does not solve for the rate making present values equal to investment cost. The analyst found the rate that makes present value of inflows exactly equal the initial cost. That's internal rate of return, IRR. IRR answers the question. What percentage return does this project earn? It's the discount rate where NPV equals zero. If IRR exceeds your required return, the project adds value. If IRR falls below your hurdle rate, reject it. NPV gives you dollars, not a rate. Profitability index gives a ratio. Average accounting return uses accounting income, not cash flows, and doesn't solve for a rate that equates values. Here's a WGU 214 OA exam tip for you. When the question describes finding the rate where PV of inflows equals initial investment, or where NPV equals zero, that's IRR. Quick recall hook. IRR equals sign internal rate equals sign rate, where NPV equals zero. 43. A financial manager must decide whether to approve a capital project and uses the decision rule that projects should only be accepted when they create value exceeding their cost. According to standard capital budgeting principles, which specific decision criterion indicates that a project will increase the overall value of the firm? A. Payback less than 5 years. B. Internal rate of return less than cost of capital. C. Positive net present value. D. Profitability index below 1. Can you guess the answer? Correct answer, C. Positive net present value. Explanation. Option C is correct because a positive net present value indicates the project generates cash flows whose present value exceeds the investment cost, thereby creating value and increasing firm worth. Option A is incorrect because payback period ignores time value of money and cash flows after payback. Meeting a payback target does not guarantee value creation for shareholders. Option B is incorrect because internal rate of return less than cost of capital indicates the project earns insufficient returns to justify the investment risk, signaling value destruction rather than creation. Option D is incorrect because profitability index below 1 means present value of benefits is less than costs, indicating value destruction rather than the value creation firms seek. Projects should be accepted when they create value exceeding their cost. Which criterion signals value creation? positive NPV. If NPV is greater than 0, the project generates more value than it costs. The firm becomes worth more by taking the project. This is the fundamental accept-reject rule. Payback under 5 years? Arbitrary and ignores time value. You could have a project that pays back in 3 years but destroys value. IRR less than cost of capital means the project earns less than required. That's rejection territory. Profitability index below 1 means benefits don't cover costs. Also rejection. Here's a WGUC 214 OA exam tip for you. Positive NPV is the criterion for value creation. Accept when NPV is greater than 0. Quick recall hook. Positive NPV equals sign project adds value equals sign accept. 44. A company evaluates a real estate development project where significant renovation costs in year 5 will cause cash flows to switch from positive to negative before returning to positive in later years. This pattern creates multiple sign changes in the cash flow stream. Why does this situation make internal rate of return an unreliable method for evaluating this particular investment project? A. Multiple sign changes produce multiple IRRs. B. IRR ignores all future cash flows. C. IRR cannot handle positive cash flows. D. Sign changes eliminate time value effects. Can you guess the answer? Correct answer. A. Multiple sign changes produce multiple IRRs. Explanation. Option A is correct because when cash flows change signs multiple times, the IRR calculation can produce multiple different rates, none of which reliably indicates project value. Option B is incorrect because IRR incorporates all cash flows in its calculation. The problem arises from sign changes creating mathematical ambiguity, not from ignoring future cash flows. Option C is incorrect because IRR handles positive cash flows normally. The issue specifically involves alternating positive and negative flows, creating multiple, mathematically valid solutions. Option D is incorrect because sign changes do not eliminate time value effects. NPV still properly accounts for timing when IRR becomes unreliable due to unconventional cash flow patterns. Cash flows go positive, then negative in year 5 for renovation, then positive again. Multiple sign changes. This is a problem for IRR. When cash flows change direction multiple times, the IRR equation can have multiple solutions, multiple different rates that all make NPV equal 0. Which one is correct? None of them really. The math breaks down. IRR doesn't ignore future cash flows, it uses all of them. The problem is the sign changes create mathematical ambiguity. NPV still works fine with unconventional cash flows because you pick the discount rate, not solve for it. Here's a WGUC 214 OA exam tip for you. Multiple sign changes in cash flows produce multiple IRRs, making the metric unreliable. Use NPV instead. Quick recall hook. Multiple signs equal sign. Multiple IRRs equal sign unreliable. 45. When net present value and internal rate of return produce conflicting recommendations about which mutually exclusive project to select, financial theory suggests that one method provides more reliable guidance because its assumptions about reinvesting interim cash flows are more realistic. Which capital budgeting method should managers rely upon when choosing between competing projects that both add value? A. Always use internal rate of return for decisions. B. Use net present value for reliable decisions. C. Average the two recommendations. D. Ignore both and use payback. Do you know the answer? Correct answer. B. Use net present value for reliable decisions. Explanation. Option B is correct because net present value assumes reinvestment at the required return rate, which is more realistic than internal rate of return's assumption of reinvestment at the often higher internal rate of return rate. Option A is incorrect because internal rate of return can produce unreliable rankings for mutually exclusive projects due to unrealistic reinvestment assumptions at the calculated internal return rate. Option C is incorrect because averaging conflicting recommendations lacks theoretical foundation. Net present value superior assumptions make it the preferred method when methods conflict. Option D is incorrect because payback ignores time value of money entirely and excludes cash flows after the payback period, making it inferior to both net present value and internal rate of return. NPV and IRR disagree on which project to pick. Both projects add value, but they rank differently. Which method wins? NPV. Here's why. NPV assumes you reinvest interim cash flows at your required return rate. IRR assumes you reinvest at the IRR itself, which might be unrealistically high. If a project has a 40% IRR, does IRR assume you can reinvest all cash flows at 40%? Yes, that's usually not realistic. NPV's assumption, reinvest at your cost of capital, is more reasonable. Don't average conflicting recommendations. Don't fall back on payback, which ignores time value completely. Here's a WGUC 214 OA exam tip for you. When NPV and IRR conflict on mutually exclusive projects, trust NPV because of its more realistic reinvestment assumption. Quick recall, hook, NPV wins conflicts equal sign. Realistic reinvestment equal sign trust NPV. 46. A company's chief financial officer is analysing the optimal combination of debt and equity financing to fund the firm's operations and growth initiatives. This mixture of borrowed funds and owner investment that appears on the right side of the balance sheet represents which fundamental corporate finance concept? A. Capital structure. B. Working capital management. C. Cash flow analysis. D. Asset allocation. Do you know the answer? Correct answer, A. Capital structure. Explanation. Option A is correct, because capital structure refers to the specific mixture of debt and equity financing a company uses to fund its assets, representing a fundamental corporate financing decision. Option B is incorrect because working capital management focuses on managing current assets and current liabilities for daily operations, not the overall mix of long-term financing sources. Option C is incorrect because cash flow analysis examines the movement of cash into and out of the business, not the permanent financing structure supporting the company's operations. Option D is incorrect because asset allocation typically refers to investment portfolio decisions about spreading investments across asset classes, not corporate financing structure decisions. The CFO is analysing the mix of debt and equity financing. That mixture is capital structure. Look at the right side of a balance sheet. You'll see liabilities and shareholders' equity. That's how the company is funded. Capital structure decisions involve choosing how much debt versus equity to use. More debt means more interest obligations but potential tax benefits. More equity means no required payments but diluted ownership. Working capital management deals with current assets and liabilities. Short-term stuff. Cash flow analysis tracks money movement. Asset allocation is an investment portfolio concept, not corporate financing. Here's a WGUC 214 OA exam tip for you. The mix of debt and equity financing is called capital structure. It's on the right side of the balance sheet. Quick recall hook. Capital structure equals sign. Capital sources equal sign debt plus equity mix. 47. A corporate treasurer explains to the board of directors why the company uses significant amounts of debt financing despite the obligation to make regular interest payments to creditors. The treasurer highlights that interest payments reduce taxable income, effectively lowering the overall cost of borrowing. Which advantage of debt financing does this tax treatment represent? A. Elimination of bankruptcy risk. B. Guaranteed return to shareholders. C. interest tax shield benefit. D. Removal of repayment obligations. What do you think is the answer? Correct answer. C. Interest tax shield benefit. Explanation. Option C is correct because interest payments on debt are tax-deductible expenses that reduce taxable income, creating a tax shield that effectively subsidizes the cost of debt financing. Option A is incorrect because using debt actually increases bankruptcy risk, since the company must make obligated interest and principal payments regardless of business performance or cash availability. Option B is incorrect because debt financing does not guarantee shareholder returns. Excessive debt can actually reduce returns to shareholders by increasing financial risk and potential bankruptcy. Option D is incorrect because debt requires repayment of both interest and principal. The tax benefit relates to deductibility of interest, not elimination of repayment obligations. Why use debt when you have to pay interest? Because interest is tax deductible. That's the interest tax shield. If a company pays $1 million in interest and has a 30% tax rate, that interest reduces taxable income by $1 million, saving $300,000 in taxes. The government effectively subsidizes your borrowing. Debt doesn't eliminate bankruptcy risk, it increases it. You must make those interest payments regardless of business conditions. Debt doesn't guarantee shareholder returns or remove repayment obligations. The benefit is specifically the tax deductibility of interest payments. Here's a WGU C214 OA exam tip for you. Interest payments reduce taxable income, creating a tax shield that lowers the effective cost of debt. That's the tax advantage of borrowing. Quick recall hook. Interest tax shield = interest deductible = tax savings. 48. A manufacturing firm has invested heavily in automated production equipment, resulting in high fixed costs for depreciation and maintenance, but relatively low variable costs per unit produced. When sales volume increases, the firm's operating income rises at a faster rate than the sales increase. Which concept measures this sensitivity of operating income to changes in sales revenue? A. Financial leverage. B. Degree of operating leverage. C. Debt to equity ratio. D. Current ratio. Can you guess the answer? Correct answer, D. Degree of operating leverage. Explanation. Option B is correct because the degree of operating leverage measures how sensitively operating income responds to sales changes, driven by the proportion of fixed versus variable costs. Option A is incorrect because financial leverage relates to the use of debt financing and its effect on returns to equity holders, not the operational cost structure affecting operating income. Option C is incorrect because the debt to equity ratio measures the proportion of debt to equity financing, a capital structure metric rather than an operating cost sensitivity measure. Option D is incorrect because the current ratio measures short-term liquidity by comparing current assets to current liabilities, unrelated to operating income sensitivity to sales changes. High fixed costs from automated equipment, low variable costs per unit. When sales increase, operating income jumps faster than sales. That's operating leverage. The degree of operating leverage measures how sensitive operating income is to sales changes. High fixed costs create high operating leverage. Small sales changes produce large income swings. This works both ways. Sales up 10% might mean income up 30%, but sales down 10% could mean income down 30%. Financial leverage is about debt, not operating costs. Debt to equity ratio measures capital structure. Current ratio measures liquidity. None of those capture the fixed cost effect on operating income. Here's a WGUC 214 OA exam tip for you. High fixed costs create high operating leverage, amplifying how operating income responds to sales changes. Quick recall. Hook. Operating leverage equals sign operating costs fixed equals sign amplified income swings. 49. An analyst compares two companies in different industries and notes that one firm experiences much greater fluctuation in operating income from year to year due to volatile demand and unpredictable input costs. This variability in operating earnings before considering how the firm is financed represents which fundamental type of business uncertainty? A. Financial risk. B. Liquidity risk. C. Business risk. D. Currency risk. Do you know the answer? Correct answer, C. Business risk. Explanation: option C is correct because business risk refers to variability in operating income caused by factors like sales volatility and operating cost fluctuations, independent of how the firm finances operations. Option A is incorrect because financial risk stems from the use of debt financing and its effect on shareholder returns, a separate risk category from operational earnings volatility. Option B is incorrect because liquidity risk involves the ability to meet short-term obligations or convert assets to cash quickly, not the variability of operating earnings over time. Option D is incorrect because currency risk relates to exchange rate fluctuations affecting international operations, a specific type of risk rather than general operating income variability. One firm has wild swings in operating income year to year. Volatile demand, unpredictable costs, that variability in operating earnings before considering financing is business risk. Business risk comes from the nature of the business itself. Some industries are inherently more volatile. Commodity producers face price swings. Luxury goods makers see demand collapse in recessions. This exists regardless of how you finance the company. Financial risk is different. It comes from using debt. Liquidity risk is about meeting short-term obligations. Currency risk affects international operations. Business risk is purely operational volatility. Here's a WGUC 214 OA exam tip for you. Variability in operating income from sales and cost fluctuations is business risk. It exists before financing decisions. Quick recall. Hook. Business risk equals sign. Business operations equals sign operating income volatility. 50. A company with stable operating income decides to significantly increase its use of debt financing, which requires fixed interest payments, regardless of how the business performs each year. This financing decision increases the volatility of returns available to common shareholders. Which type of risk has the company added through its capital structure decision? A. Business risk. B. Operating risk. C. Systematic risk. D. Financial risk. What do you think is the answer? Correct answer, D. Financial risk. Explanation: option D is correct because financial risk arises from using debt financing that requires fixed payments, magnifying the variability of returns to equity holders compared to an unleveraged firm. Option A is incorrect because business risk relates to operating income variability from sales and cost factors, existing regardless of how the firm chooses to finance its operations. Option B is incorrect because operating risk is another term for business risk from operational factors, not the additional risk from fixed debt payment obligations added to the capital structure. Option C is incorrect because systematic risk is market-wide risk, affecting all securities that cannot be diversified away, not risks specifically created by an individual firm's financing decisions. Stable operating income, but the company adds significant debt. Fixed interest payments every year regardless of performance. Now shareholder returns become more volatile. That added volatility is financial risk. Financial risk arises from the capital structure decision to use debt. Debt requires fixed payments. Good year, shareholders get what's left after interest, which could be a lot. Bad year, same interest payment, less left for shareholders or nothing. The debt amplifies return volatility to equity holders. Business risk exists from operations regardless of financing. Operating risk is just another name for business risk. Systematic risk is market-wide. Financial risk is specifically from the debt decision. Here's a WGUC 214 OA exam tip for you. Risk from using debt that magnifies shareholder return, volatility is financial risk. It's added by the capital structure choice. Quick recall. Hook financial risk =, financing with debt =. Fixed payments amplify swings. You have reached the end of our first question set. For the free complete exam preparation, visit our website link in the description, where you find thousands more practice questions and comprehensive study guides. Thanks for studying with us today. See you in the next video.